Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Carson here with a look at the action in today's session, where we saw a bearish signal, and we'll take a look at some key levels on the major indexes, Ed, but a key development in this beginning stages of a market rally, but not all too surprising in a bear market.
No, not too surprising. We'll definitely get into that. We'll also take a look at a few stocks, Exxon Mobil, Vertex, and Google, all making important moves.
That we will. But first, let's take a look at the major indexes. The Nasdaq today down 3%. The S&P 500 down 2%. The Dow down by 1.6%. The Russell 2000 down some 1.8%. So we recently had a follow-through day with the Nasdaq getting above its 21-day line. A little bit of an asterisk with it because on the volume, we did have volume running lighter until the end of the session, and we did have the Russell rebalancing. And we've been saying, Ed, that follow-through days, that's not your pedal to the metal signal, and to be wary of them in the middle of bear markets because this can be tricky. And so with the close below the low of the follow-through day, it's pretty bearish.
Yeah, it was pretty bearish. So when you get through there was some economic data that both revived recession and inflation fears, which is really not a good combination.
Right.
And so we closed below the low of the follow-through day decisively on the Nasdaq. We just by a hair did it on the S&P 500 right at the close. And when that happens, research shows that there's a 90% chance that the rally will ultimately fail. And now the rally doesn't fail until you get all the way to the low. So it isn't dead, but it's one of those nearly dead kind of situations that you don't really want to be in. There was a lot of, there was a lot of reversals today. A lot of stocks falling below key moving averages. So there was just a lot of negative action going on in addition to the indexes. So, if you took a position, if you added some exposure, you probably want to be scaling back, because chances are, if you bought on the follow through day, well, you're probably down on those positions. Yeah. Some will not, but most will. Because even if you bought at the very beginning of the day, you're below it. So just a bad sign in that regard. You still want to be paying attention to things, but definitely not what you would want to see.
And another thing that provides some more encouragement on a follow-through day is when we're seeing a lot of stocks that are high quality setting up, breaking out. We weren't really seeing that. It was almost kind of a joke, I feel like, that we were saying, oh, you're seeing more stocks setting up short ideas than on the long side. So that's something else to keep in mind. If you're seeing more stocks that are setting up to short versus buy and hold out of strong bases, then that also should tell you something.
Yeah, it was interesting to hear so many talking with David Ryan and talking about shorting options when the market was still looking okay today. And so that is definitely an issue. Look, if we move sideways for a while around here or wherever it is, then maybe you could see some more bases and more setups. So then when we had a rally, a really strong market, then you could see maybe it would really sustain itself. But yeah, not many stocks to buy, and they don't look, and those that were looking like buys don't look so good now.
And we always want to tiptoe in on a follow-through day. And once again, there wasn't a resounding confidence, I think, behind this. If you've been watching the show, been watching IBD Live, been reading our coverage, there's definitely reasons to be cautious out there, but you have to listen to the day-by-day signals. So just as we listened to that tiptoe signal a couple of days ago, we're definitely going to be listening to this pretty loud bearish signal about scaling out as well.
Absolutely.
Okay, moving on, let's take a quick look at the Russell 2000, a big downside reversal outside bar right at that 21-day line. We can also take a look at the Dow, same as well. So big reversals lower here in the market. And the 10-year Treasury yield looks like it edged up a bit today. So continuing to move higher, coming down to that 3% level last week, but bouncing higher once again.
Yeah, and so that didn't move a whole lot, but that combination of recession, inflation fears, and there was some other news like Intel cutting PC prices reportedly. So there's a lot of news out there that just didn't encourage people. And yeah, it's that kind of market.
Yeah. Well, let's take a look underneath the surface. The energy sector, which has been hard hit in recent weeks, we were noticing as a bright spot in the session today. So XLE up about 2.7%. This does have heavy weightings in Chevron and Exxon, the latter of which we will be taking a closer look at here shortly. But this is something that we're keeping an eye on because the sector is showing some signs of life still. It's not just completely crumbling, trying to find a bit of a bottom and moving a little bit higher here.
Yeah, I mean, this isn't completely destroyed like some of the other commodity sectors. We'll see. I mean, it's trying to bounce back. The volume isn't as heavy as some of the losses on the downside there. And obviously, if oil prices keep coming up, that'll be interesting. There's an OPEC meeting tomorrow. There usually isn't too much news at these OPEC meetings, but something to watch for tomorrow.
Mm-hmm. Okay, and we also want to take a look at XLV, which is the healthcare sector ETF. Not good to see this coming down by about 1.7% today, but it did have a strong move. So I think that's the interesting thing, Ed, is you were talking about how that was the one area where we were starting to see a lot of compelling setups. But after several strong days up in a row, we were saying, you don't want to be buying them now. That would be chasing. Wait to see, are they going to pull back? Are they going to pause? Are they going to trade tightly? So hopefully investors out there heeded that warning instead of maybe getting into some of these stocks yesterday, for example.
Yeah, and Vertex we'll be taking a look at that. That's a component in here. A lot of that's a good point. With short-term rallies, you need to move quickly and not get in line. You can't get away with what you might in a strong bear market where you can buy anything at any time and it seems to work. But it is important that you notice the 50-day line. That's hitting resistance there. And that also happened with ARK, which is a very different type of ETF. But that one also, last couple of days, hitting resistance to the 50-day line. A lot of mega caps this week hitting, the SARK, which is their inverse way to play it. SARK is bouncing back, but a lot of mega caps, a lot of indexes hitting resistance or falling back below the 50-day line, 10-week line, a place where you'd expect to hit resistance. It doesn't mean it's terrible. I mean, ARK did not undercut its lows from this month versus May. So that's that. It's just, we're coming up at areas that the market has had trouble at and we're having trouble.
Mm-hmm. All right, and yes, I did bring up that SARK ETF. This is a way to play play ARK short, and what you do with something like this is just how with SQQQ, we don't look at technical levels on SQQQ to buy it. We look at QQQ. So if you saw that resistance and that move lower for ARK at the 10-week line, maybe this is something to consider here. But as always, just make sure you're managing your risk with any trade. And now let's take a look at Exxon Mobil, XOM, trying to get back above its 50-day line, maybe a little bit of resistance there, but still up about 2.8% on the day. So it would be great to see Exxon get back above the 50-day line. But even still, I think that's potentially a little too early to be trying to buy something like this, which did come down pretty swiftly in the last couple of weeks.
Came down pretty swiftly, and there was some volume on some of those days, not as much volume on the way back up. I mean, unlike a lot of energy stocks, which came down to the 200-day line are now trying to bounce off of this held up reasonably well. I mean, arguably the old buy point of 89.90 is still technically valid. I mean, it's been a while now. You sort of stretch, but it's not obviously a failure. Yeah, maybe when it was getting above the 21-day line today, you could start saying, maybe. But
yeah, maybe.
Maybe. Again, it's all very tentative. It's just a tough situation when you just feel nervous. By the time you wait, where do you buy it? Because then if you wait till it shows a lot more strength, then it might get extended. I mean, ideally, something like this would move sideways for a while, right, and then maybe bounce off the 50-day line, or form a new base. But there's so many damaged stocks, even stocks that are holding up better, even the ones that look best. You sort of look at it and go, do I really want to be buying that? And yeah, I think we've gone over this stock a number of times because it's one of the better looking ones. Yeah. But there's reasons to still say, I don't know about this one.
Right. Yeah. I mean, a retake of the 50-day line can it definitely work. We talk about that a lot. I think just putting it in the context of what kind of market we're in. And also when you see that kind of heavy volume selling, some of these things just might take a little bit more time to play out. Like you said, Ed, let's see if it can tighten up here and then move higher, really prove itself a little bit more and give us a little bit of time to see the stock digest that weakness that it had. And next on our list, let's take a look at Vertex Pharmaceuticals, VRTX, coming in pretty significantly, at least in a visual sense here on the chart, Ed. 3.9% decline after a streak of big gains with volume behind the move to the upside. But once again, not all too surprising. Of course, we don't want to see this, coming all the way back down like it did, but at least some sort of pause seemed likely, just given the strength of the move over the last 2 weeks.
Yeah, and so this is why there was an early buy point of 279.23 that had there, because it had a sort of failed breakout. So 279.23 was sort of the new buy point. It's below that. Not that surprising. Yeah, there were some places maybe you could have bought there, and that was early in the when the market rally attempt was coming up. So you could have done there. You could have gotten 279. It's come back below that 279 point at least, maybe not the trend line. It's above the 50-day line. It's not terrible. The volume isn't that bad. As you say, a bunch of gains over the past several days, up until this week. But it's just something that to note. And again, when a lot of stuff is coming back down, that's what's happening right now. Leading stocks didn't show a whole lot of strength, or there wasn't a lot of pockets of strength outside of energy. And most of those stocks look damaged from their selling in the prior weeks.
Right. And I feel like something we've been talking about too is it's not enough to just recognize sector rotation and leading industry groups and move your money there. You have to also make sure that even if that group is leading, you don't want to be buying extended stocks, because even stocks in the strongest groups it can shake you out if you're not too careful in chasing these names.
Yeah, you've been very good about talking about the importance of early entries. And yeah, with these short-term rallies, you just can't wait until 2 weeks into a run, because that's usually when the run is going to stop. And it seems like in this market. So yeah, you wouldn't have wanted to buy, because technically the official buy point was 292.85 at this point. And you could have gotten it on last Friday right there, because it got above there. And then now you'd be down 5-6% from that point. Not a good situation, so that's why, we've been talking about early entries, because it's just not the kind of market that lasts.
Right. Yeah. I think we've all been beating that drum pretty hard. All right. Let's take a look at Google parent Alphabet reversing lower, down about 3.4%. We didn't see heavy volume behind this move. I think that was one of maybe the sticking points with a number of short setups that we were looking at, as we weren't seeing heavy volume to the downside, but reversals after weak rallies at key moving averages nonetheless. So taking a look at a weekly chart, we can see it did get above its 10-week line last week. It's now right around that level, but a lot of mega caps, as you said, Ed, are hitting resistance at these levels.
Yeah, and it's like it sort of came up to its June highs. I mean, may not have quite gotten there. So you combine that with around the 50-day line, just, it's just having trouble here. Now, this is one that didn't undercut its May lows. So this is one of the stronger mega caps. So that's one reason I wanted to highlight it. This is one of your leaders in that respect. I mean, not really a leader.
But, and it's still having trouble. Having
trouble. And then the fact that the relative strength line didn't fall that much, because given how the market sold off today. Right. But yeah, so there's just a lot of signs. It's not just the indexes. You dig down, the giants are struggling. The leading stocks are struggling. So there's, whatever the reason is, you can always try to find some slivers of hope, but you look around and go, like, there's a lot of negativity for good reason. So investors should take that in heart. There's a lot of concerns about this market rally, and it may not, look, just the macroeconomic conditions may not improve for several weeks or months. I mean, maybe the market rallies ahead of that at some point, but it's the conditions aren't really ripe for a strong rally.
Yeah, they're not. And I think just in closing, so taking a step back here, Ed, that it's really important to be flexible, to be nimble, and you have to protect your capital first and foremost. In a bear market, it can be very tempting to get sucked in when you start seeing signs of a bottom, signs of strength, but we have to remain patient and disciplined for when those favorable conditions do come our way.
Yeah, because you don't want to miss out when it really does turn. So just stay engaged. Every once in a while, it's okay to take little pilot positions in here, knowing to scale right out again if they don't work. But yeah, be flexible. Listen to the market. Don't try to impose your will. I feel like we should be bullish now. Don't do that. The market will let you know when it's time to really be bullish.
Yeah, and I think it cuts both ways too. That's another thing we've said is it's hard to really be making any big bets either way right now, just because of the volatility, because we've been so beaten down. People are, have been pushed to the sideline. So there's a lot of different, maybe mixed messages to kind of sift through. But I think managing risk at the end of the day is the most important thing to be doing right now. Totally agree. All right, everyone. Thank you for tuning in. We'll be back with more tomorrow morning on IBD Live, where we will be joined by Scott St. Clair. He's manager of IBD's Premium Products Group. We'll be reviewing with him a couple of new screens that have been added to MarketSmith, 2 that are especially good, we hear, for coming up with short ideas. So we look forward to Scott's review of that tomorrow on IBD Live, investors.com/IBD Live for all the details on that. We'll see you there, everyone. And we'll see you right back here tomorrow after the close.